everybody's talking about the housing market slowing down, whether or not it's going to crash and we're entering into a recession, and all of the talk can take someone off course. That's what I wanted to talk about today, is how do you stay on course? Because interestingly enough, the people who have money and the people who want to buy are still buying. We're seeing that they're taking a little longer, they're taking their time, they're looking at their options. We've got one of our employees is looking at purchasing her second home, converting her first home into a rental. And she was even looking at open houses this weekend, saying, I don't need to rush. Like, I've got more time. Interestingly enough, though, Tina Maldonado, if you're watching this, she just had a situation where it was multiple bids, over asking, and went quick. The market is not uniform. So how can you take advantage of opportunities? I was working up a presentation that I'm doing tonight for Audrey Mars and a group of wannabe investors, meaning looking at purchasing their first single family as a house hacking situation or a duplex as creating rental income, just not jumping in to purchase a home, but purchase a home with income opportunities. Well, I was putting together the presentation for Audrey Mars last night, and I started thinking about this. So CoreLogic put out their report, and I've got it right over here. So CoreLogic's report actually showed that appreciation for the last year, and this is as of July, so it's very recent, appreciation as of the last year was at 18.3%. The Denver market was just lower than that at a hair over 17%. That's still really strong. I mean, if I go to the DMAR 11 county area, our year over year median price growth is 11%. So it's still in double digits, but median price growth is different than appreciation. And we need to know that appreciation is really the measure of a singular home every time it's sold, calculating the gain of that home. That's what CoreLogic, which is this massive data aggregator, is measuring. DMAR, the Denver Metro Association of Realtors, can't do that. It's just not built for it. It's going to take the MLS data and tell you what the average and the median price home sold for, which can be swayed by lesser price home selling or higher home prices selling. So we've got an 18.3% look back over the last year. Forward looking, CoreLogic says we're expecting a 4.3% appreciation. That seems really low. But does it? I mean, it seems normal. The normal historic United States appreciation, not Denver, but across America, is 3.6%. Now, that's pre-pandemic. That number was increasing as far as the historical average kept going up because you had to throw in 2020 in there and 2021. But the historical average pre-pandemic was 3.6, and here we're expecting 4.3% appreciation and growth. So that's a really strong housing market. But there's some things that are going to happen between here and there, and that's what I want to talk about with this massively big view on the fact that 4.3% is really good. Like, it's really good. We don't need, nor do we want 11% median price growth, nor 18.3 annual appreciation. It keeps those first-time homebuyers out of the market, or it even keeps those of us who want to move up somewhat out of the market, depending on what it is or where it is that we're selling. Obviously, real estate is hyper-local, but I put this kind of quick numbers together for them tonight. So if you're going to join us tonight, you'll have seen this already, so I'm sorry, I'm kind of spoiling it. But here we go. A purchase price of $615. So I'm using kind of a Denver median price point. It wasn't specifically tied to the DMAR Market Trends report, but $615 is a pretty common house for a first-time home buyer today, which blows my mind. I complained about the fact that my first home cost $200,000. In fact, I sold it for $200,000. It cost me just over $100,000. I sold it for $200,000 in Dallas, and then my mind was blown when I moved to Evergreen and purchased a home for $300,000. Now a regular first-time homebuyer home is $600,000, so $615,000. If we put 5% down, which is just over $30,750, and you appreciate 1 year, at the 4.3%, and you lock in an interest rate of 4.99% based on your appreciation, which is $26,445, and your principal reduction because you're paying your own loan back. I mean, think about that. If you're renting, you're paying somebody else's mortgage loan down, not your own. And in yours, your rent goes to principal reduction. Yes, some of it is interest, but some of it is a forced savings plan. That principal reduction over the first year is $8,635. You add those two together, that's a $35,080 return on my $30,750 investment. That's a 114% return on investment. Now tell me that 4.3% isn't a good appreciation rate, right? I mean, it's about perspective. So when people are telling you that they're waiting for the bubble to burst and they think home prices are going to drop, and I actually got an email from a borrower of ours, and bless him, I really want to convert him, but he's afraid that we're going to see drops in home values of 30, 40, or even 50%. Drops in home values of 50%. The worst housing crash ever saw a 25% price reduction, which is what we saw in 2008. A 25% price reduction nationwide. Here in the Denver market, our median price dropped 11% in its worst year. Now again, remember, there's a difference between appreciation and median price growth or loss. But still, 25%, very worst year, and he's thinking we're going to drop 50%. So here's a couple of things that you need to know about that happening, right? So in 2006, we had over 26,000 homes here for sale in the Denver market. That was a 5 months of inventory, which is high for the way we run. Nationwide, we had 11 months of inventory. We had a massive number of spec builds on the market. We had home buyers who literally didn't qualify for a single thing, buying 2, 3, 4 homes at a time with no money down, with 80/20s and option arms. We had an average credit score in the mid 600s. Today we have an average credit score of 718. And I go back to this. In 2006, we had incredible inventory. Beginning of this year, so 26,400 units for sale in 2006 here in the DMAR 11 county area. At the beginning of 2022, we had just over 1,000. Now, since then, we've had more active inventory come online. We're seeing that. Active inventory was up like 82%, 81% year over year, right? Active inventory was up, but it was not because of new listings. New listings were actually down. It was because demand had slowed down with increasing interest rates. So as demand follows the dips of interest rates, which we've seen over the last 3 weeks until Friday, when the unemployment numbers didn't quite come out as we expected it to stay at 3.6. It dropped down to 3.5, showing some people were leaving the workforce and more jobs were created, really kind of blowing the whole recession out of the water until coming up, right? It's like you can't really have a recession when you have more jobs being created, part of the definition, although I understand the whole 2 consecutive quarters of GDP decline. I go off track. We're talking about the fact that I am still making good money on my money at 4.3%. The idea that we can lose 50% when I had started the year with 1,000 in active inventory, which has come up, but now that increase and that velocity is slowing down, right? So the new listings we already saw were down year over year, not up. Demand was slowing down. As interest rates drop, this is where I left off before I started down the whole unemployment situation, right? Over the last 3 weeks before Friday, we saw demand pick up. Mortgage purchase applications were actually up 1%. I know we saw it here in our team, the Rueth team. So as buyers are looking for opportunities, you have some people that are saying, I'm waiting for this bubble to burst. And I'm saying, it's not going to happen. It's not going to happen because we simply don't have enough inventory to support a gluttony, right, of homes for sale that allows home prices to drop. Because Tina just saw it this weekend. If a home is priced right and staged right, it's going fast for multiple bids and over asking. Yes, some homes are staying on the market. And there might be a reason for that, whether they're overpriced or they're in a slightly less desirable neighborhood or a less desirable location, or maybe they haven't been maintained. But this is where, as a home buyer and an investor, we have to think broader than just out of fear, because fear ties us down to inaction. That 114% ROI is real. Like that, I didn't make that up. That's based on a 4.3% appreciation, which is really in line with where I think things will go. My fear is if we continue to see active inventory, I mean, we're still in the beginning of August. If active inventory week over week and month over month slows down in the speed by which it was increasing until typically around October, it starts decreasing. And if we land the year with not enough inventory and we start January, where we start the spring season, and the Denver market is notorious for picking up steam, either right after football is over, or even in the last 2 years, it was right after the turn of the year. Buyers are coming out. If we hit a recession, if the economy slows down, because the Fed now in September, now they still have some time between now and their meeting, but they have the green light based on the unemployment numbers that came out on Friday to continue to raise the Fed rate. If they do that to control inflation, inflation will start to come down. When inflation comes down, interest rates come down. Demand will come up, because we've got demand that's been sitting on the sidelines waiting for the bubble to burst. When they realize that we don't have enough inventory for that, something you and I already know, they're going to come out the moment they see those interest rates drop, and we're going to see an entire frenzy again next spring. Now, I could be completely wrong because my crystal ball broke a long time ago. But I don't think I am. Like, I really think that if we continue to see the slowdown in active inventory, where it continues to increase, but at a slower pace until around October, where that starts to go back down again, and it goes down to the end of the year. And if we don't have enough pickup in inventory, and if we start 2023 below 3,000 in active inventory, well, we've seen what that does. That's all I'm saying, right? I mean, we kind of know where that story goes. So as a home buyer or as an investor in today's market, don't look at the fact that some homes reduce their price. Because I know that nationwide, although we're seeing almost 40% of the homes drop their list price before they go under contract, and here locally we're seeing those numbers as well, I know that that's because sellers didn't get the memo that they couldn't sell for what their neighbors were selling for. Because their neighbors has put their house on the market, then you had multiple bids, upbidding, and then you finally closed over ask, sometimes 25, 50, 100,000. The guy next door saw that and go, they just closed for 100,000 more. I want that price. Maybe you should start at this price. Right? What is the normal trajectory? That was frenzy. That was an unhealthy buyer demand based on limited supply. It's simply economics. It's supply versus demand. So if I saw that and I still want that, but nobody's paying that because there's not a frenzy, I'm going back to the trajectory of appreciation that was in line, then you should come back down to here, right? Maybe a little more, but certainly down from there. So as sellers readjusted, we will see that that percentage of homes that have to have a price reduction before they go under contract come back down. And typically, seasonally, you're going to see that anyway. There's always kind of a heated market in June and July. Now, the extreme by which we saw this pick up is because of the interest rates. There's an amount of seasonality that goes to it, but the interest rates put that kind of fire in the belly, right? So the trajectory was swift. That is starting to slow down. as that curves over, again in that October timeframe, we're going to see a little bit less inventory, a little bit less over asking, not as many buyers because you're heading into the holidays. They'll whittle through that inventory, and then we'll end up at the end of the year, leading into next year, back on fire. Now, if I'm a home buyer right now, and I even thought for a second that we were going to see a bubble, well, number one, you'd be wrong. But if I didn't want to call you out like that, I'd simply go through the facts of how much inventory we have, how we still have demand, how we still have the demographics, how the oldest age is still 30 and the average home buyer is 33, how we have 2 trillion more in savings, how those buyers who want to buy are still buying. Mortgage purchase applications were up 1% immediately as soon as we saw interest rates drop at all, which tells you that the demand is on cue to get going and to buy on the dips. Right? So with this lack of inventory, with this accelerated pent-up demand, with the economy actually doing really strong and unemployment down from 3.6 to 3.5 and more people getting jobs, even though, yes, job openings came down because some companies are waiting out to see what this recession is going to look like, there will be job loss. And regretfully, those same people that lost opportunities during the pandemic will probably be pinched again during this recession. But those people who invested, whether it's in the stock market or Bitcoin or houses or investment properties during the pandemic, did very well and will continue to do very well and will have the money to buy. That is why we will not see a bust. Plus the fact that you have investors looking to crowdfund and purchase up real estate. People, with the speed of the internet today, we are finding people jumping on the bandwagon, doing the crowdfunding, and purchasing loads of single-family homes and apartment buildings. Again, looking for the opportunities and buying on the dips, propping up home prices. So while they will come down to a more normalized historical value or rate of appreciation, I should say, not value, but rate of appreciation, I can still win. I can still win. I just showed you the numbers, 114% ROI. I'm feeling pretty good about that if I'm a home buyer or an investor. And as I go tonight to talk to these investors, I'm really excited about their opportunity. And if you want to learn more about investing, this Thursday night, we're doing it live in person, not on Zoom. We're coming together, doing the happy hour, doing the food, doing the drinks, and we're talking about what it looks like to invest in this market. Because it might be scary, but I'll tell you, the opportunities are there for those who are willing to jump in when other buyers are waiting for the bubble or waiting for prices to drop or waiting for rates to drop. You're getting in, you're getting a renovation loan, you're getting a fair price for that home, you're getting an interest rate that's good. Come on. Everybody's talking about how high interest rates are. They're still really low. You're getting an interest rate that's good. You're building your own equity through appreciation, albeit slower. You're building your own equity through principal reduction because it's your home, not your landlord's. And you can refinance not only when the rates drop, but in the meantime, rebuild it so that it has income opportunities and it's exactly the home you want to live in, not somebody else's idea, which is a rental. Although I like being a landlord because I like the opportunities and my tenants like renting from me. It works for both. That's it. I'm going to keep this one short. I love this market because of the opportunities that while other people aren't looking, those who are can jump in. Nicole, Rueth with the Rueth team. I'll talk to you guys soon.